Welcome to the Daily Fortune, where we talk about the latest topics about finance and investment. But before that, please don't forget to click the like button, subscribe, and hit the notification bell so you'll know when we upload a new video. Now let's get started. Have you noticed that everything became suddenly so expensive over the past few months? Copper prices have nearly doubled in the last years. Oil too has near doubled its price. Even sugar has increased by 50%. But wait, there's more. Assets such as stocks, cryptos, and real estate are all significantly up year over year. So let's use the hashtag prices on the rise. In this video, we'll know everything about this particular asset that has been in a massive bubble and is ready to pop up anytime soon. So are we gonna pop it or just pop it? Let's find out what asset class that is and how it's gonna affect the economy and other asset classes in general. So let's go. Cathie Woods, an American investor, founder and CEO of an investment management firm, which is ARK Invest, has recently spoken about this one asset. Over the last months, the economy has been seeing an exciting and unusual trend that has generated a large bubble. As the pandemic started, consumers have been spending more money on goods rather than services, especially during the times where services were forced to shut down.
Did the consumer spend on goods, non-durable and durable goods? Because those were the only items that consumers could spend anything on. Services were pretty much shut down. Now, what's interesting about this is goods make up actually less than a third of all consumer spending. Services make up the rest. So for the past year, the consumer, pre-vaccination especially, was focusing his or her spending on goods, just a third of a typical budget. And consumer spending rose as a share of total spending to more than 40%. I don't think it's been that high in the United States in quite some time. As a result, we believe that consumers have actually been building inventories themselves at home.
Cathy also believes that this is not sustainable and that spending in this area will drop below 30% in a few months. So firms would be left holding the bank because they will have a large inventory with the same amount of predicted demand. The majority of us have already bought products such as computers, air conditioners, and washing machines. This results in us not needing to buy a new computer, a new air conditioner, or a new washing machine because we already have those products which we can use for a long time. Consumers are increasingly availing services, while expenditure on commodities is on the decline. But because consumers who spend on goods haven't reduced significantly, the price level for items have risen. And because firms are unable to meet the high consumers' demand, businesses have placed large orders for materials for their supply chains, causing raw material prices to rise. The value of raw materials is skyrocketing, with lumber costing nearly 4 times as high. Consumer demand for goods are starting to rise, much to the surprise of businessmen that have been struggling to satisfy the strong demand. As vaccinations become more widely available and almost all have already been vaccinated and got their booster shots by now, consumers are spending more money on services like traveling to meet friends or even eating outside and going on vacation. But this is all about to come together and have very catastrophic consequences.
Now, what we think is also happening is that businesses are still scrambling, trying to catch up. Inventories relative to sales are at a record low. And as a result, the businesses are losing sales, and they've become a bit panicked about it. And so the scramble continues. And usually when I hear panic and scramble, it means double ordering, triple ordering to make sure to get those supplies so that they won't lose sales in the future. Meanwhile, the consumer has already shifted to services. If we look at the numbers in April,
they were expected to increase by 1%, but they had already increased by 10.7% in previous months. Nonetheless, it was a surprise in comparison to expectations. The main problem now is that businesses that sell goods have placed an excessive number of orders for supplies. However, because consumers have already stocked up on goods and are now spending on services, businesses that sell goods will have to cancel a significant portion of their orders for the materials required for their supply chains. And because of these cancellations, commodity prices will plummet, affecting other asset classes such as stocks and real estate. By the way, this isn't simply something Cathy is speculating about. There is data and recent statistics on consumer purchases that back her theory up. Cathy also said, if you look at real consumption in April, it was down slightly, but if you look at real goods consumption in April, it was down 1.3%. Now this makes sense because if you look at the past year, real goods consumption increased 74%. Think about that. In the last year, the consumption of durables has increased 74%, and so now that the consumer is filled up on durables, and I'm sure non-durable goods as well, the spending towards services has begun. And we did see services consumption up 0.6% that month. From this scenario, commodities are rapidly declining. Businesses ordering enormous volumes of supplies have inflated the commodity bubble. And now, due to these cancellations, commodity prices are about to collapse. Cathy compared this occurrence to the cartoon character Wile E Coyote falling off a cliff. Commodity prices are on the verge of falling off a cliff. There is a serious drop in the price of commodities. One example is the price of copper. Copper price reached $4.90 down to $4.50. The lumber prices peaked at $1,711 and are now down to $1,200. It's a pretty huge drop if we look at it. Currently, it's hovering a little below $1,300. Now that we know there will almost certainly be a commodity price crash, you may be wondering how this will affect other asset classes in which you may have invested in, such as stocks and real estate. First, if commodity prices fall, this will act as a deflationary force, as the price of goods will fall as well. As a result, inflation won't be as high as expected. Cathy is actually seeing investors predicting this right now, as bond yields are falling, indicating that investors aren't as concerned about inflation as they appear to be. One important indicator that Cathy has said is beginning to confirm that this could be a little bit truer than the skeptics would suggest. The 10-year Treasury bond yield has decreased from 1.75% to 1.55%, and today we saw salaries that were higher than expected, as well as inflation indicators that also seemed higher than should have been. Despite this, the bond yield is falling. And so the indicators for inflation are currently higher than expected. Bond yields, on the other hand, are falling, indicating that investors think inflation will be lower than expected as commodity prices decrease. The bond market is something that all investors should keep an eye on, since it provides signs about what's to come. Every recession, for example, was preceded by an inverted yield curve in the bond market. In fact, back in 2006, the bond market predicted that energy costs would skyrocket. Currently, rising commodity prices and inflation have caused value equities such as energy and financial-related firms to appreciate greatly in the short term. I'm pretty sure that you've noticed Tesla and other growth-oriented stocks have dropped. However, when commodity prices crash and inflation falls short of expectation, road stocks may benefit from reduced interest rates. Furthermore, value-oriented companies have risen because of short-term recovery growth rates. However, when recovery spending decreases, these value stocks will no longer be as appealing as growth businesses that are increasing at a much quicker rate.
As we've been saying for quite some time, that the bull market is alive and well, and it is broadening towards value and cyclical sectors. Or maybe I should say it has broadened. This has happened, and we thought it would. And we thought it would hurt innovation-oriented strategies. It has done that as well.
Cathy just suggested it, and all basing it on the evidence they're seeing. These cyclical sectors are putting themselves up for a downturn, which should benefit innovation. Today is the best time to invest for the long term. It's a great opportunity, just as Cathy believes. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.